sucker rewritten script. A unique set of tax regulations might drain $75,000 from an elderly property owner's pocket during the sale of their longtime residence. This happens without any fraud, without concealing information, simply due to one well-intentioned household choice that rarely gets discussed. An Ohio resident I'm aware of learned this lesson through difficult experience. Her property ownership spanned 34 years. Last year's sale seemed like it would trigger zero tax obligations. Her entire adult existence happened there. Children grew up within those walls. Mortgage payments ended years prior. Straightforward transaction, new beginning. Her obligation reached $23,400. The choice creating this situation occurred at her dining room table during a weekday afternoon while she believed she was acting prudently, believing she was safeguarding her loved ones. 10 minutes covered the entire process. Anyone past 60 who holds property title needs to understand that April 15th represents the cutoff, determining whether this gets resolved discreetly or becomes problematic. This statement carries absolute seriousness. You'll learn precisely what occurred and its relevance to your current situation. Before diving deeper, one quick clarification. Today's information relies on existing IRS regulations and federal taxation statutes, including the recently enacted One Big Beautiful Bill Act that became law July 4, 2025. This video cannot replace guidance from a certified tax expert. Consider this your starting point, never your conclusion. This presentation addresses 4 pitfalls, 4 entirely normal property owner choices quietly generating IRS complications for elderly individuals currently. Next comes 3 opportunities potentially returning funds to you on your 2025 filing that most individuals past 60 haven't discovered. Following that, a 7-step action plan featuring a complimentary resource on the IRS's official website revealing precisely what property information they possess. Most individuals only discover the pitfalls. Very few discover the funds they're forfeiting. This video's conclusion will provide both perspectives. Stay until the end. These 4 pitfalls create one word: home. H represents home equity errors. O represents ownership and title modifications. M represents move-out scheduling before selling. E represents extra revenue from the property. Before continuing, if today's content proves valuable, please click the like button and distribute this to anyone you know past 60 who holds property. That single distribution might preserve someone thousands of dollars. Those needing this information most typically discover it last. Now, completing her narrative. Her identity is Margaret. She represents a fictional combination constructed from authentic situations tax experts encounter routinely. Every individual mentioned throughout this presentation follows this pattern. Authentic outcomes, combination personalities. Margaret's spouse died several years back. Her daughter Sarah became actively involved afterward. Shopping trips, maintenance work, medical visits, everything. One afternoon, Margaret's neighbors suggested that including Sarah on the title would simplify matters eventually, bypass probate, maintain family ownership. Common sense seemed evident. Margaret proceeded, county recorder's office, basic paperwork, no lawyer, no tax expert, no second thoughts necessary. Here's what Margaret never learned. Transferring partial property ownership to another individual, including your offspring, can trigger IRS classification as a taxable gift. Based on transferred value, this might require reporting on Form 709. Upon eventual sale, the individual added to your title might not receive the identical tax exclusion you receive because that property never served as their principal residence. Margaret discovered this 2 years afterward when her tax preparer reviewed her filing and spoke 4 unexpected words. We need to talk. Every penny of that obligation was avoidable. The IRS ignores motivation. It examines actions and proper documentation. Good intentions appear nowhere on tax filings. So, addressing the home equity errors. Continue with me because this section causes most viewers' attention to drift. That drifting attention precisely creates financial losses. Most property owners assume that funds originating from their property must connect to the property for taxation purposes. This assumption is incorrect. Full stop. An elderly person borrows $40,000 or $50,000 against their property through a HELOC. They utilize it for grandchild's education, medical emergency coverage, or debt reduction. Because funds originated from the property, they assume interest becomes deductible. It doesn't unless funds purchased, constructed, or substantially enhance the property securing the loan. That's the regulation under the Tax Cuts and Jobs Act of 2017. If funds went elsewhere, that interest represents personal interest, not deductible, and incorrect claiming creates discrepancies that IRS automated systems increasingly detect well. Consider now, did you extract home equity or establish a HELOC during the previous 3 years? Where did those funds actually go? Into the property or elsewhere? If elsewhere, you need discussion with a CPA or enrolled agent before April 15th, because if that interest received incorrect handling, steps available now become significantly harder after deadline passage. The O pitfall causes the most disagreement when I present it because listeners hear it and immediately respond that cannot be accurate. That's simply a family choice. I hear that every single time, and every time I respond identically. That's precisely why it's so dangerous. An elderly person adds an adult offspring to the title for estate planning, probate prevention, or simply because that offspring has been assisting and it feels appropriate. What feels like a family choice is simultaneously a tax choice. These two things don't always desire the same result. Consider the previous 5 years now. Has anyone's identity been added to your property? An offspring, a grandchild, anyone? If affirmative and no gift tax filing occurred that year, continue listening because this upcoming section specifically addresses you. Adding someone to your title without them paying fair market value allows the IRS to classify this as a taxable gift. When transferred value exceeds the annual exclusion threshold, a Form 709 gift tax filing is typically required depending on transfer structure and your particular situation. If that never got filed, that's a documentation discrepancy sitting quietly in your history. Upon eventual sale, the individual you added to the title might not receive the principal residence exclusion, the regulation allowing most property owners to exclude up to $250,000 in capital appreciation or $500,000 for married couples because they never resided there. Their portion of the appreciation might be completely taxable. A sale that should have generated 0 taxes becomes partially taxable over a title modification that required 10 minutes. I've spoken with elderly individuals who discovered this at the closing table, not before the sale, not during the listing, at the closing table. Documents already before them. That's when they heard it. There's also the basis consideration. If you transferred the property entirely as a gift rather than maintaining it as an inheritance, the recipient receives your original purchase price as their cost basis, not today's value. If you paid $80,000 and the property is valued at $380,000 today, they might owe capital gains taxation on $300,000 upon selling. Had they inherited it instead, the basis would adjust to current market value, and that appreciation would largely vanish for tax purposes. One approach cost the family nothing. The alternative cost them tens of thousands. The sole difference is the transfer timing. Now, that particular reason, April 15th, matters more than individuals recognize. The IRS has an automated system called the Automated Underreporter Program. It cross-checks your tax filing against third-party information. Mortgage servicers, rental platforms issuing 1099-K forms, and property-related records. The discrepancy between what you reported and what the IRS can observe has been narrowing for years. Tax experts are observing more automated notifications and more matching inconsistencies than at any recent point. After April 15th, if something hasn't been resolved, interest begins accumulating automatically. Penalties accumulate. And the first-time penalty abatement program, a genuine documented IRS policy allowing taxpayers with clean compliance history to request significant reduction or elimination of certain penalties, becomes harder to utilize once assessments are completed. Earlier action provides more alternatives. Now, the move-out scheduling. This is the one hitting elderly individuals hardest, and it's the most misunderstood regulation in residential tax law. Under IRS Section 121, to exclude up to $250,000 in capital appreciation from your property sale, $500,000 if you're married filing jointly, you must have resided in the property as your principal residence for at least 2 of the 5 years immediately before the sale. That's the 2 out of 5 regulation. Here's where it quietly destroys individuals. Let me demonstrate exactly how this occurs. As I walk through this illustration, I want you to visualize your own property, your own address, And consider where you have been residing for the previous 3 to 5 years. You relocate to your adult offspring's residence because of a health condition, or into a smaller residence while your property remains on the market, or you begin renting it while you wait to sell. All of these are understandable choices. All of them affect your residency calculation. Say you relocated to your daughter's residence in January 2021. You maintained the property, attempted to sell, couldn't achieve the price, rented it for a year, and finally sold in March 2026. You relocated January 2021. Sale completed March 2026. That's more than 5 years since you last resided there. Under the 2 out of 5 regulation, you might not receive the exclusion at all because both qualifying years fall outside the 5-year look-back window. If the property gained $200,000, you might owe capital gains taxation on the full amount. For most property owners in this income range, that's roughly $30,000. Not because you did anything wrong, because retirement circumstances and a tax timing regulation collided in a way nobody warned you about. There are partial exclusion provisions under Section 121C for health-related relocations. They're genuine, but they require documentation and don't apply automatically. And here's something I want you to remember, because Dorothy's narrative in a few minutes demonstrates exactly what happens when this pitfall combines with the next one. If you have relocated from a property you still own and plan to sell, count the months this week. The window to address this exists right now. And now the extra revenue from the property. This is the one individuals dismiss first because the amounts feel small. That dismissal is exactly what makes it expensive. An elderly person rents a spare bedroom, maybe through a short-term rental platform, maybe just to a college student, maybe a family member pays something modest to stay in the basement apartment. It covers the utilities. It feels like a practical arrangement. But the moment your property generates rental revenue, any amount, any arrangement, the IRS treats that portion differently. 3 things change. First, that revenue must be reported on Schedule E. Informal arrangements are not exempt. No formal lease doesn't mean nothing to report. Second, a portion of your property expenses become potentially deductible against that rental revenue, but without documentation, you either face audit exposure or you overpay. Third, if you later sell the property, the rental portion might not receive the principal residence exclusion. The appreciation gets allocated between residential and rental portions. The rental portion can be taxed as a capital gain, and depreciation recapture under Section 1250, taxed at up to 25%, can apply to the rental portion even if you never claimed depreciation in the first place. That spare bedroom you rented for $600 a month for 2 years can affect the tax treatment of your entire property sale. Not just that bedroom, the whole transaction. Now Dorothy is 68, Tennessee, resided in her property for 27 years. In 2022, a health scare pushed her to relocate to her son Michael's residence. Temporary, she told herself. To cover expenses while she waited to sell, she rented the property to a young couple, $1,100 a month. She didn't report it the first year because her accountant had just retired and the software she used didn't ask the right questions. The following year, Michael added his identity to the title just in case Dorothy's health got worse. No gift tax filing occurred. Early 2025, Dorothy sells. 27 years of ownership. She walked into that closing expecting a clean, essentially tax-free sale. The IRS determined she had relocated more than 2 years before the sale. The rental period had changed part of the property's classification. The title change created a gift reporting discrepancy. The unreported rental revenue was a separate obligation underneath all of that. Dorothy owed $23,400 across 3 separate issues, none of which she knew existed when she made the choices that caused them. She wasn't negligent. She wasn't concealing anything. She was a 68-year-old woman managing a health crisis, a housing transition, and a family situation simultaneously without anyone telling her what she needed to know. Dorothy did not fail the system. The system failed Dorothy, but the system doesn't adjust itself based on that fact. That's the whole reason this video exists. I want you to sit with that for just a second because what comes next is genuinely different from everything we have covered so far. And most individuals watching this are going to wish they had known it sooner. Now, the other perspective on this, because everything so far has been about problems, the next few minutes are about funds you might be leaving on the table right now. Real funds verified by the IRS, available on your 2025 filing. The first is brand new, and most preparers are not highlighting it automatically. It's called the Senior Bonus Deduction, and it's part of the One Big Beautiful Bill Act signed July 4, 2025. If you are 65 or older, you can now claim an additional $6,000 deduction on top of whatever you already deduct. Whether you itemize or take the standard deduction, it stacks on top of both. Married with both spouses 65 or older, that's $12,000 total. Available for tax years 2025 through 2028, phases out starting at $75,000, modified adjusted gross income for single filers, and $150,000 for joint filers. For many elderly individuals in the zone where 50 to 85% of Social Security is taxable, this deduction pulls taxable income down enough to reduce that exposure. It won't eliminate Social Security taxation entirely, but it can meaningfully reduce it. For many elderly individuals, that's $1,000 to $2,500 in real savings. This provision was buried in a 100-page bill. Some tax software has not been updated. Some preparers have not caught up. Ask your preparer directly, did you apply the senior bonus deduction from the One Big Beautiful Bill? If they look confused, find someone who doesn't. The second is the SALT deduction increase. From 2017 through 2024, the state and local tax deduction was capped at $10,000. For property owners in New Jersey, New York, California, Connecticut, and Illinois, where property taxes alone often exceed $10,000, that cap was painful. You paid the taxes. You got no deduction for the excess. As of 2025, that cap is now $40,000. For 2026, it is $44,000, increasing 1% per year through 2029. The phase-out starts at $500,000 in modified adjusted gross income, well above where most retired property owners sit. Here's the problem. When the cap dropped to $10,000 in 2017, millions of property owners switched to the standard deduction and never looked back. 8 years on autopilot. The cap has quadrupled. Their habits have not changed. If your property taxes plus state income taxes exceed $10,000, run the numbers again. Add your total SALT to your mortgage interest and charitable contributions. If that total exceeds the standard deduction for your filing status, you should be itemizing. If you already filed using the standard deduction when itemizing would have saved you more, you can amend within 3 years. Don't leave that money sitting there. The third is the energy credit. If you installed solar panels, a heat pump, battery storage, or other qualifying energy improvements in 2025, the 30% federal residential clean energy credit is still on your filing for that installation. The One Big Beautiful Bill eliminated this credit effective December 31, 2025. Systems installed and operational by that date still qualify. Systems installed January 1, 2026 or later do not. The IRS has confirmed the cutoff is based on when installation is completed and the system is placed in service, not when you signed the contract or paid the deposit. If you have a 2025 installation and have not yet filed, make sure that 30% credit is claimed. On a $30,000 system, that's $9,000 you don't want to leave behind. For future upgrades in 2026 or beyond, that federal credit is gone. Some states still have their own programs, but the 30% federal credit that millions counted on is no longer available for new installations. Now, this last one is different. It's not about your tax filing at all. It's not about something you did wrong. It's about funds leaving your bank account every single year right now that you might be able to stop today with a 20-minute phone call. And there's one more thing most elderly individuals have never been told about. This one has nothing to do with the IRS. It's a state and local property tax benefit, and it varies by where you reside. But for many individuals watching this, it's worth more overtime than anything else in this video. Almost every state in America offers a property tax homestead exemption for elderly individuals. These are not small discounts. In Texas, the over 65 homestead exemption alone can reduce your property's taxable value by $60,000 or more on top of the standard homestead exemption, saving some property owners $4,000 to $6,000 every single year. Florida freezes your property tax assessment at the value it was when you first qualified, meaning even if your neighborhood doubles in value, your property taxes don't go up. Georgia offers full exemptions from school taxes for qualifying elderly individuals. New York, Pennsylvania, Ohio, Illinois, almost every state has a version of this. Here's why this should make you genuinely angry. These exemptions are not automatic. Nobody sends you a letter when you turn 65 saying your taxes just went down. You have to apply. You have to go to your county assessor's office or appraisal district, fill out a form, show proof of age and residency. If you have been 65 or older for years and never applied, you have been overpaying. Some states allow retroactive applications going back 1 or 2 years, meaning you could get a refund on taxes already paid. Call your county appraisal district this week. Ask what senior property tax exemptions are available. Bring your ID and your title or a recent tax statement. It takes about 20 minutes. And for many individuals watching this video right now, that call will save more funds over the next 10 years than anything else covered here today. Now, before the checklist, 60 seconds on something that has nothing to do with taxes. It has to do with protecting yourself from individuals who will use everything you just heard against you. Every tax season, scammers target senior property owners aggressively. Phone calls, emails, individuals pretending to be IRS agents saying you owe funds right now and will be arrested if you don't pay by wire transfer or gift card. The real IRS doesn't call you demanding immediate payment. The real IRS doesn't accept gift cards or wire transfers. The real IRS doesn't threaten arrest over the phone. The real IRS communicates through official postal mail with a notice number in the upper right corner of every letter. If anyone contacts you claiming to be the IRS and creates urgency around immediate payment, hang up. Delete it. Report it to the IRS phishing hotline at irs.gov. The issues in this video are real. The individuals trying to exploit your fear about those issues are also real. Know the difference. Now the action checklist, 7 steps this week. Step 1, pull your last 3 years of tax filings. Look at Schedule A for mortgage interest. Look for Schedule E, rental revenue lives there. Look for any 1099 connected to the property. Anything missing or unexpected, write it down. Step 2, find your title. County Recorder's Office can provide a copy online for a small fee. Check every identity listed. If an identity was added in the last 5 years and no Form 709 was filed, that needs professional review before April 15th. Step 3, map your residency timeline. If you have relocated from a property you still own, calculate how many months since you last resided there as your principal residence. If that number is at or past 24 months and you have not sold, get professional review before the sale completes. Step 4, check your IRS account transcript at irs.gov. Create a free account. 15 minutes, you'll see every notification on file for your account and every piece of third-party information the IRS has matched to your Social Security number, including 1099-K information from rental platforms. If the IRS has information about your property that doesn't match your filing, you'll see it there. Knowledge is the only thing that gives you alternatives. Step 5, track your home equity records. Find documents for any HELOC or home equity loan. Write down exactly what those funds were used for. If they went into the property, you likely have a clean paper trail. If they went somewhere else, your filing may need review. Step 6, list every rental arrangement the property has had. Any amount, any arrangement, dates, and amounts. A tax expert can tell you what was handled correctly and what needs to be addressed. Step 7, contact a CPA or enrolled agent this week if you have any uncertainty after steps 1 through 6. The National Association of Enrolled Agents has a free directory at naea.org. Search by location and specialty. When you call, ask specifically whether they have experience with IRS penalty abatement for real estate issues. That one question tells you immediately if they are the right individual. Dorothy did none of these 7 things. Not because she was careless, because nobody gave her this list before she needed it. You have it right now. Use it. The cost of a professional review is almost always smaller than the cost of the problem it was supposed to prevent. Let's bring it all together one final time. The 4 home pitfalls. H. Home equity. Funds from your property aren't automatically property-related under IRS regulations. O. Ownership changes. Adding someone to your title is a tax event whether you intended it to be or not. Move-out scheduling. The 2 out of 5 regulation doesn't pause for retirement or health transitions. E. Extra revenue, rental revenue from your property changes its tax classification, and that change follows the property all the way to the sale. The 4 things working in your favor right now: the $6,000 senior bonus deduction available on your 2025 filing, the SALT cap at $40,000 if you're in a high-tax state and still on standard deduction autopilot, run the numbers again, the 30% energy credit for 2025 installations that have not yet been filed, and the senior property tax homestead exemption sitting unclaimed at your county appraisal district that could save you thousands every year. If even one of the 4 pitfalls sounds familiar, don't file this away as something to think about later. That's exactly how Margaret ended up hearing those 4 words. That's exactly how Dorothy ended up owing $23,400 on a sale she expected to be clean. Start with step 1 tonight. The deadline is April 15th. By then, what could have been a quiet fix becomes a scramble, and scrambles are expensive. If this video helped you, hit the like button right now. Subscribe if you're not already here. Share it with anyone over 60 who owns a property, and drop a comment below. Which one of these did you not know about before watching? That question genuinely helps me decide what to cover next, and your answer might be the topic of the next video. In the next video, I'm going to walk through Form 709, the gift tax filing that most elderly individuals never completed when they changed their title, and show you exactly how to address that discrepancy before it becomes a formal IRS notification. If Margaret's situation sounded familiar when I told her narrative at the beginning of this video, that next video is specifically for you. It's already on your screen. Watch it now, because this is exactly the kind of topic where waiting costs you more than acting.